Welcome back to the Deep Dive. Today we're looking at your market sources for December 6th, and there's a real tug-of-war happening. It's all about the world's favorite waiting game. What is the Federal Reserve going to do next?
Exactly. And that anticipation is creating some serious hidden volatility. So our mission today is to cut through that noise. We're going to synthesize the data macro, stocks, crypto, and give you a clear picture of the market's real risk posture.
Okay, so let's start with the bond market. This is where you can really see the tension. The U.S. 10-year Treasury is, stuck around 4.11% to 4.14%, but the 2-year is way down at about 3.5%.
Right, and that spread between the 210 spread, is narrowing. But, and this is the important part, it's not deeply inverted. Not yet, anyway. A deep inversion is that classic flashing red light for a recession.
So the market is nervous, but not panicked. It's betting on a rate cut, right? Like the Reuters surveys show everyone expects one.
Precisely. It's priced for a perfect soft landing. But the underlying data is still mixed, so the Fed is being cautious. And that's the tightrope we're on. If the Fed doesn't deliver those cuts, that curve could snap.
Okay, that makes sense. So with all that tension, let's talk about liquidity, the actual cash in the system. I know there's been a big shift there.
A huge shift. We have to talk about the Fed's overnight reverse repo facility, the ONRRP. Think of it as a giant savings account for the banking system's extra cash.
And that balance has been dropping.
It's dropped significantly, down to around $1.49 billion. This is a big deal because it means that flood of easy, short-term cash that's been propping things up, it's receding. The system is getting more discerning.
Wait, okay, if liquidity is drying up and the bond market is on a knife's edge, why is the VIX, the fear index, so calm? It's sitting at, what, 15 or 16?
That's the million-dollar question, and it points to the real story. The VIX is low because the volatility isn't everywhere. It's highly concentrated. Investors aren't dumping everything. They're just sitting on their hands waiting. That calm is the calm before a potential storm.
So capital isn't fleeing, it's just flowing to very specific places. And that brings us to the equity market, where we're seeing this massive divergence. Some stocks are doing great.
Astonishingly resilient, yeah. But only in what the market calls high-quality technology. Look at VOO or QQQM. They're holding their highs. Capital is consolidating into what it sees as safety.
And by high-quality tech, we're really talking about the big AI names.
It's entirely concentrated there. We're talking NVDA, holding firm around $182. Meta, drawing between 662 and 674. And GOUD, steady around 320. The whole debate is whether AI demand can actually weather a potential economic slowdown.
Right. Is the valuation justified, or is it just a bubble where everyone is hiding? Now let's flip to the other side of that coin, the high-leverage world of crypto.
And here's where things got messy. BTC was trading strong, up in the 89 to 92K range. But in the last day or two, we saw a massive derivatives liquidation. Hundreds of millions of dollars in long positions just wiped out.
Ouch. So a lot of leveraged traders got caught.
They got caught completely flat-footed. And that forced selling dragged the whole sector down. It immediately reset the sentiment. The crypto fear and greed index swung right back towards fear neutral.
And ETH followed suit, I imagine.
Yep. ETH moved in lockstep, which tells you this was a macro, leverage-driven clean-out, not a problem with a specific project. It just shows how choppy this environment is. Dollar cost averaging is really the only sane strategy there right now.
Which leads us to the really speculative fringe, the pre-stocks like Anthropic and XAI being tracked on chains like Solana.
It's fascinating. You have Anthropic signing a $200 billion deal with Snowflake, which keeps that pre-IPO hype train running. But offering exposure through tokens on Solana is, well, it's regulatory arbitrage. It's extremely high risk.
So putting it all together, the nervous bond market, thinning liquidity, selective stocks, and the crypto washout. What's the big picture?
The big picture is that the market is in a structural repricing phase. It's all driven by that macro uncertainty.
So the strategy from the sources is pretty clear then. Risk management is job number one. Hold more cash than usual. Stick to defensive assets.
Exactly. And for your core positions, maintain that selective exposure to quality AI and tech, but as long-term holds. Don't try to trade them. For crypto, just stick to dollar cost averaging in BTC and ETH. Avoid leverage completely.
And for the really high beta stuff like those pre-stocks,
strict, unwavering risk control. Tiny positions, less than 1% of a portfolio with hard stop losses. This is not the time to gamble.
So for you, looking ahead, it really all comes down to the next batch of inflation and employment data and just parsing every word from the Fed.
It does. But this whole situation raises a bigger question you should be thinking about. If all this private capital is flowing into companies like Anthropic,
keeping their valuations sky high before they even go public. How is that going to end? Will regulators like the SEC have to step in? Or are we setting up for a major reckoning when these companies finally try to IPO in a public market that might not agree with those private valuations? That could reshape the entire IPO landscape.